With a new administration taking office on January 20th, the housing market faces potential changes that could reshape the landscape for homebuyers, renters, and investors. Today, we're covering how the Trump administration could impact the housing market and economy. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
Today, we're talking to economist and assistant director at Moody's Analytics, Matt Walsh. We'll dive deep into what we know about Trump's plans for the housing market and economy, from tariffs affecting construction costs to immigration policies impacting labor and housing demand. We'll dive into the key questions on everyone's mind. So let's bring on Matt. Matt, welcome to the Real Wealth Show.
Great. Thanks for having me, Kathy. It's great to be here.
Let's start with what you do at Moody's.
Sure. So I'm an economist at Moody's Analytics, where I work with the research department, where I cover all things kind of residential housing and a little bit of CRE too. So our group is tasked with creating forecasts for the next year for these major macroeconomic variables. We do a lot of writing about different macroeconomic trends and trying to translate that to our clients. So my focus, again, primarily on the residential side, but happy to talk about all things real estate.
Wonderful. Well, let's start with the new administration. That is, it's January, so a lot of people have been anticipating what the Trump administration will do in regards to housing. So what were some of the things that the Trump campaign proposed?
Sure. So I guess some of the policy proposals, I think maybe the most permanent ones for the housing market. And I guess I'll start with maybe the most broad that have the broadest implications for the housing market, maybe drill down to some specific things. So, first, I think it's important to talk about the tariffs. I think that's one of his major economic policy proposals here that have real implications for both builders and maybe through indirect channels for monetary policy and inflation. So maybe on the direct impact here, before I pivot to those indirect impacts, there have long been tariffs in place on Canadian lumber, and I think that's maybe one of the examples that come to mind when thinking about how these tariffs may impact the housing market that drive up business costs. And there's been a lot of research done to kind of quantify the impact on price to home buyers, and the NHB, the National Association of Home Builders, has done a bit of work to estimate the increase in costs from Trump's first round of tariffs on Canadian lumber in 2018. They found that it's about a $9,000, $10,000 increase in costs for single-family housing. So it is a pretty significant increase in cost to buyers. In terms of kind of the indirect effect, this would be higher inflation expectations that could result in the bond market responding with higher 10-year Treasury yields. The Fed may react, and it looks like they have. Their most recent FOMC meeting, if you look at some of the minutes, there's a lot of discussion about increased inflationary risks in the outlook here for next year, given these tariffs. And that may mean that they kind of reduce the expectation of drawing down interest rates next year, and the bond market obviously kind of responding to that. By lifting yields here, by pushing up yields higher on 10-year treasuries. So that ultimately pushes up kind of the 30-year fixed rate mortgage. That kind of, those two are closely intertwined here. So that would mean higher rates for home buyers, and ultimately that's coming at a time when affordability is already strained, and I think that certainly does not help the affordability situation.
Sure. I mean, in a real life situation, I just spoke with a builder yesterday. We were selling lots in a project we have in Park City, and he wants a significant discount on the lot to make up for what he thinks will be an increase in material costs through these tariffs.
Sure.
And I do hear from different people, certainly from Trump supporters, who say, oh, he's just bluffing. This is how he gets deals done, and it's not, he doesn't want to create inflation. Of course, I'd like to believe that. Of course, I'm trying to sell a lot for the highest price. And so would you say there is merit to this builder saying, oh, no, I need well, in this case, he was asking for about a $50,000 deduction. And you're saying the difference would be about, I think you said $9,000 or $10,000. So right there, I've got a number I can use. I appreciate that.
So that's on average. Remember, that's on average across builders across the United States. So, and
Yeah.
that was
Yeah. It's a
2018.
4,000
It's
square foot house. So it
sure.
probably, yeah, it's a little bit bigger. So do you think that there's any truth to that, that Trump is bluffing and that's how he negotiates? Or, I mean, it sounds like there's enough data and research to say that in the past, there was an increase in costs.
I think it's likely that Trump does pursue some kind of tariff here. If we
Mhm.
take his first administration as kind of the foundation or as an outline to what can happen this time, it is likely that there will be some tariffs put in place. He can act on his own here. He doesn't need congressional approval to do this, um, and I think we can kind of take him at his word that there will be some tariffs, some change to trade policy
Mhm.
that uses tariffs.
Yeah.
Now, I think the magnitude of those tariffs and kind of what products get tariffed and or levied tariffs against them, where what exemptions are put in place is still very much an open question. It's a little difficult to kind of tease that out now, and we're really, I think, us here at Moody's are taking a bit of a kind of a wait and see approach, and we have some
Yeah.
assumptions in place of what that means for inflation and monetary policy, but in terms of kind of the direct impact on certain products, there's still a lot of script to be written here.
Yeah, absolutely. We just don't know, right? And everybody has to do their best to prepare regardless of where it goes. So the effect, I think you just said it, but I'll repeat it, that one of the effects of inflation is that translates generally into higher mortgage rates. And yet I'm seeing a lot of people, economists, predicting that mortgage rates will kind of stay where they are. So that's been confusing to me, because it's like, well, if we're going to see inflation, we're probably going to see higher mortgage rates, but who knows, right? We can't predict these things, but that would just be my intuitive guess.
Sure. Yeah, I think the impact on inflation again is pretty modest. I mean, it's
Okay.
definitely tangible, and I think our revisions to our inflation forecast for next year are pretty small. I think it takes some time for this to kind of filter through the economy. It again hurts different sectors differently, right? I think
Hmm.
building, manufacturing are two areas of the economy where we can expect to see some more tangible effects of tariffs. But I think overall, it may be pretty modest on net. Um, in terms of kind of what that means for interest rates, I think that's still kind of an open question. I mean, we were expecting a pretty modest decline in the mortgage rate next year, kind of before later this past summer, before Trump won election. Kind of our baseline view was really status quo for the economy next year from 2024. And that entailed kind of a modest reduction in the mortgage rate as the Fed kind of slowly unwound monetary policy and the bond market responded to that. Um, with that kind of taken out of our forecast here, we have the Fed pausing next year and waiting for more clarity on what happens in terms of the trade policy. Um, that in turn leads to higher rates for longer in 2025. So I think that's
Exactly. Exactly. I mean, it's so confusing, because I just listened to a report today, not from you guys, from somebody else, that was saying, oh yeah, well, obviously the most recent inflation report came out a little bit better. And
mhm,
so we did see the 10-year come down a little bit today.
sure.
Again, what is today? Today is January 15th for whoever, is listening to this at a later date. We did see the 10-year come down, which is good for mortgage rates. So that's good. And then this person said, yes, that means that the Fed will likely cut. And there's talk about that. And I'm thinking, how can it be, based on what you just said, that it's still so unknown what these tariffs are going to do and what's going to happen in the coming year in regards to inflation? So what is Moody's predicting or expecting in terms of potential rate cuts this year?
Yeah, it's a great question, and I think there's been a lot of change in the past few months in terms of kind of the expectation for monetary policy for all of us economists, right? Not just here at Moody's. There's a lot of discussion about kind of the change in the path ahead. Our view is that the Fed is going to kind of pause here, right? So the
Hmm.
meeting in 2 weeks, they're gonna pause. December, they cut by 25 basis points, and that'll be the cut for the next few months, at least ahead. They're gonna kind of wait and see the impact of the changes in policy, both, I should say trade policy, but also kind of on the immigration front too. That has been such a tailwind to the U.S. economy over the past few years, easing some of the labor constraints that have pushed up wages in 2022 and 2023. That has kind of helped the labor market slowly unwind um, at a more gradual pace, and something that has been a bit of a help on the inflationary front. So ultimately, I think the Fed sees those two as being inflationary and posing a risk to 2025. They have this data-dependent approach, this commitment to data-dependent monetary policy, and I think they're going to stick with that. And I think today's report, um, maybe in a different environment, a different outcome of the presidential election, may mean something different for monetary policy. Um, you know, if the path ahead was a bit more clear, I think it may have been something a bit different. But ultimately, I think the Fed is going to wait and see here. And I think that's made clear in their summary of economic projections too. So if you look at the
Hmm.
September projections, the median Fed member expected 100 basis points of cuts in 2025. That's down to 50 in December, right? So
Yeah.
take that with the minutes. Ultimately, I think you come to the conclusion here that the Fed is more cautious than before, and risks are certainly mounting to the downside, right? Being able to thread this needle of um, kind of a labor market that's slowing, still kind of persistent inflation, despite today's report that's a bit softer, came in below expectations, at least core inflation here, the most important kind of measure of price pressures. With kind of these external changes to policy, I think it becomes a little bit harder to navigate the path ahead. And that
Yeah.
is certainly reflected in their projection. And I think that is consistent with our view of the Fed and the monetary policy in the year ahead.
It just makes sense, but I guess there's just still so much wishful thinking out there. Oh my gosh, we had a good inflation report. They're going to cut rates. So like, not
Sure,
so quick.
certainly. Yeah, yeah.
Yeah, yeah, absolutely. Okay, so I think I know both candidates were bringing up this issue of affordable housing. And it seems that both candidates really realize that the solution to that is providing more housing, right? That it's a stuck market, and the only way to unstick it is to build more supply. And they both kind of had opinions on that. Has Trump come out with any ideas around that? Besides, I think there was the selling of federal land. But what is it? What is Moody's expectation for housing supply and demand in the coming year?
Sure. So I guess to level set first, let's kind of talk about the baseline view here. That's really no change to kind of housing policy,
Mhm.
and from my understanding, that is kind of the key view. I think he's talked about deportation being a kind of an avenue for making housing more affordable, but we are of the view that deportations would do the opposite. Actually, would be
Right,
pretty
right. You
inflationary for
would
the
lost
housing
your
market.
labor. Yeah.
Sure, sure. So I guess to start though, the baseline outlook here. So on the demand side, the expectation here is very little change in kind of current levels of demand. Housing affordability is still so low, and we've done a bit of work to kind of quantify the amount that house prices would need to change, incomes would need to rise, or the mortgage rate would need to fall to kind of restore the levels of housing affordability seen in 2019. And based on those calculations, we'd expect to see home prices fall by about 40%, incomes rise by about 70%, or
Oh
the
boy.
mortgage rate fall by 460 basis points to restore the
Yeah.
level of
Not gonna
affordability seen in
happen.
2019. Yeah, all else
Yeah.
equal, right? So it's a far cry from what we
Yeah.
could reasonably expect from the U.S. economy, absent any drastic shock that would lead to major changes in monetary policy or what have you. Um, and given that, I think it's unreasonable to kind of assume that we see demand come roaring back, despite kind of the demographic support. There are a lot of prime age home buyers here that maybe can't afford to go back into the housing market. So little response from demand that could improve if the mortgage rate falls more than expected, but really kind of things stay where they are. That being
And
said,
when
there
you say demand, you're talking about to buy homes, but demand for housing is as strong as ever, right? But just might translate into more rental demand.
absolutely, yeah, absolutely, yeah. So when I say demand, I guess I mean buyers in the market
Buy,
rather
yes.
than
Hmm.
the more fundamental view of demand, which is household formation, the population.
Hmm.
That is very high right now, and in fact, there's a lot of pent up households, um, who are in should be in the market for a home right now, but aren't because they can't afford to do so.
So
So
they're kind of forced to rent, which when there's low supply on that side too, and yet you see apartment starts slowing down, and how it's a tough nut to crack, right? We at Real Wealth have been focused on build to rent, and that's what we've been doing. We are trying to fill that gap because so many build to rent companies have stepped out. It's just become too expensive to provide it.
sure, yeah, and I think a lot of that due to monetary policy over the past few years, right, is like
Mm.
getting the financing correct to be able to afford to go out and build those units is challenging, and I think that's kind of why we've seen there's been a lot of building during the pandemic on the multifamily side. Something that we keep an eye on closely is this kind of large pipeline of units that are expected to come online. But if you look at starts and permitting on the multifamily side, that has come in pretty substantially, and a lot of that is just in response to higher financing costs and
Yeah.
also softening in rents as well. We've seen rents kind of turn over and move sideways nationally. And if you look in some markets, they're falling. Like Austin is a great example of where there's been a lot of building on the multifamily side, and rents have really responded to that by coming in. So
Well, hopefully there'll be more policies to help builders bring on the supply, subsidizing costs somehow. I don't know. There's just got to be a solution for builders to want to jump in the game because builders depend on investors and investors don't go into the deal hoping to lose money, right? So,
absolutely, yeah.
yeah. Any other policies that could help housing become more affordable that you're seeing?
Yeah, I'm encouraged by the discussions at the local and state level of zoning reform. And I mean, ultimately, the key here is that we need to build more housing and build the kind of housing that is affordable, smaller housing units. There's been a lot of research done recently, kind of showing that builders are responding to the affordability crunch by building smaller units, building a bit more densely. Um, yeah, that's not happening across the United States. It's really kind of segmented in certain markets. But that is encouraging, and I think this is one thing that's a little bit hard about housing policy at the federal level is it's difficult to kind of change the local policies that have the greatest impact here um, on housing affordability, right? Because ultimately we need to expand the number of housing units to improve affordability. By our estimate, we have a housing shortage of about 2 million units. That is the number of units to take to kind of bring the equilibrium or bring the vacancy rate back to some level of equilibrium, and
Hmm.
also add those housing units or those households that have been pent up because they can't afford to purchase a home. So really, it comes with kind of lowering the regulation, both zoning regulation and others, at a local level to increase that building and lower the cost to do so.
And also, a lot of this affordable housing lands on the developer and out of the developer's pocket. I can tell you on our developments, we in order to be able to build, we need to provide 30% affordable housing. And then we're locked into those prices. So in our Park City project, we're happy to provide affordable housing to the teachers and the firefighters and police officers who need to be able to afford to live there. But that burden falls on us and our investors because we're locked into these prices that we can sell them at, and yet material costs have soared. So we're losing, I mean, just giving you a real life situation, we're losing probably, I think we can sell these units for about $350,000 and it's costing us 7 to 800,000 to build them. So, that's the type of thing where like, why would we ever do that again? We're not going to do that again unless there's some kind of subsidy. It just shouldn't always fall on the developer. And I know a lot of people think, well, they have enough cushion, there's enough money there, and that's just not the case today. So
Hmm.
it's a tough one, but hopefully with Trump being a real estate developer, he will be able to grasp this and find a solution. But deregulation, yeah, that's a big one too. And I'm sitting here now as we speak right outside of Pacific Palisades in Malibu, where we have very high regulation. And you saw the homes. It's tragic what has
Mhm.
happened. And I wonder, based on regulation here, if some of these homes are even going to be able to be built, based on coastal commission rules and so forth. So it's gonna be very interesting a few years ahead.
Sure, sure. Yeah, I also think I have a lot of questions in the year ahead about, not only do we have the housing affordability problems with, the high interest rates and the high mortgage rates and the high cost of housing, but you also have those costs associated with owning a home that aren't, directly tied to that. I they are directly tied to that in the sense that, insurance costs are very high, taxes are very high, um, because housing costs have increased so quickly and replacement costs are so high. That certainly does weigh on homeowners too. I think those markets across the United States that affect across markets across the United States is largely idiosyncratic. Places like California and Florida, but do pose a pretty significant risk to the housing market in the year ahead.
All right. Well, let's talk about Freddie Mac, Fannie Mae, FHA, the VA, Veterans Administration. Uh, these are basically subsidized. I believe these are government-backed mortgage programs. There's been so much talk about changing them. Where does that stand today, and how would that affect the housing market? Because they really have been great. Obviously, the VA loans are wonderful for veterans. FHA is
Sure.
great for first-time home buyers. So there's been so much talk about changing these. Has there been any proposals yet?
Yeah, I think the proposal that comes to top of mind here is a lot of talk about ending the conservatorship of Freddie Mac and Fannie Mae, and essentially I think ultimately, kind of weeding through the legalities of this and what that exactly means is ultimately that this would translate to higher um, interest rates charged to borrowers who have a loan that's securitized by Fannie and Freddie, because ending conservatorship of the two GSEs here would remove the explicit guarantee, right? Like when those entities were brought into conservatorship, the federal government made explicit the idea that, should they get into problems, that the government would bail them out here. Ending that without some type of congressional legislation to make that implicit guarantee explicit, as it is in the conservatorship, would mean that investors would need to, would expect a higher risk premium here, um, on those assets. So that would ultimately have to come from somewhere, and that would be in the rates charged to those borrowers. So this is not a great time for that in terms of kind of what that means for
Yeah,
housing affordability.
right.
This is maybe the worst time to do that.
Pretty bad timing there. Yeah.
Right. And I think this is in stark contrast to the first Trump administration when rates were much lower. And there was a lot of discussion about, um, ending conservatorship then, privatizing Fannie and Freddie uh, back then. And it's a bit of a different environment now. So I'm sympathetic to the arguments for ending conservatorship. I think now is maybe a bit of a tough time to do so, at least in terms of its impact on the housing market. How exactly that plays out is a little unclear to me. I think there's a lot of script to be written in terms of kind of the impact of that, both in terms of mortgage rates and house prices and home sales. Still a lot of research to be done there, but ultimately, kind of the my initial take here is that it would be a bit of a tough time for that, and could be a downside risk to house prices next year.
Yeah, yeah, and making it more and more, even more difficult to buy a house, and therefore creating more rental households. All right, Matt. Any last comments for our listeners who are mostly single family rental investors, but we've got commercial real estate investors as well, and some who own apartments.
Sure. I mean, I guess kind of my view for the year ahead is there's still a lot of uncertainty here, a lot
Mhm.
of different scenarios for the housing market, and I think the risks are a bit balanced but skewed to the downside here, and ultimately kind of what happens largely depends on policy. So I think that's something that we're watching closely, and kind of expect to clear up next year in 2025.
Yeah, what's crazy is that with every administration, even though there are different policies, we have seen housing prices go up over the years, regardless of who's in office. And I think that just comes down to there's a lot that goes into building a house. You can't just throw one up. It's not that easy. So as we As there's more demand, less supply, that drives prices up. All right, Matt, thank you so much for joining me here on the Real Wealth Show. It's really a pleasure to have you here.
Yep. Thanks for having me, Kathy. It's great to be here.
And thank you for joining me here on the Real Wealth Show. If you want to find out more about our build to rent syndications, just go to realwealthshow.com, click on the Invest tab, and you'll see the drop down for our syndications. And if you prefer just to buy a brand new property as a rental, you can do that too by speaking with one of our investment counselors at Real Wealth. It's free to join and free to speak with one of our investment counselors. Plus, you'll get access to over 500 free webinars on how to save money on taxes, how to get asset protection, what to ask a property manager, and so much more. Again, that's at realwealthshow.com.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.